Holy crap. Are we experiencing stagflation with Delta and inflation fears rising all at the same time? We're both having a demand shock and a supply side shock. And what are we going to do about this? Where are we going to turn to? Well, the short of it is, so that you don't have to go all the way to the end of the video, is technology is going to be ripping right now. And we've already seen that because Microsoft yesterday just kind of blew people's minds away when they said a very small thing: they can raise prices. And we were like, whoa, tech raising prices? After 10 years, they've never raised price. At least they don't really raise prices. It's all about increasing the quality and increasing customers. We need more daily active users, more monthly active users, that kind of a thing. But now we're even being able to see the potential that tech might not just do bad in a big, higher inflation environment, but they actually could do okay if it could pass it on. Like if you're a big tech company with plenty of cash flows and a strong, solid customer base that you're deeply intertwined with. Microsoft, Google, Apple, I'm not so sure. And we can go into this video a little bit more, but that's what's going on in the markets this week. So if you want to follow me and understand exactly how this works, I'm going to drill down into it, but it's going to be a little bit of a longer video. If not, don't worry, press the like button and subscribe. And thank you guys very much. But here we go. Okay, first we have Delta. And Delta I've been talking about. I actually kind of predicted what was going to happen this week in the markets, basically a few weeks in advance. I've been talking about it. I even said, whatever. I even said that we're going to have the drop on Monday and Tuesday and Wednesday and Thursday that we had due to the consumer sentiment report, because it indicated something pretty significant. And I'll jump to that real quick. The surveys of consumers by the University of Michigan provided us a low 70.2. Just perspective, the lower number of 70.2, I haven't seen that for, I don't know, ages. We didn't even see that in the March bottom last year. What we did have was around 71. So now consumers seem to be hit worse than ever before, and people were like, wait a second, maybe Delta is doing this. But when I look back at it and we actually see the consumer inflation report that we got from the Bureau of Labor Statistics earlier in the month, this all starts connecting to me. I'm starting to think, hey, this lower supply side, this lower inflation reading of 0.5, which, gosh, I mean, 0.5 is still a high annualized figure. That's a 6% inflation rate annualized. That's still not low, but it's the lowest one since February. And we were like, yay, this is transitory. We're getting over all the supply chain stuff. We're getting more inventories, etc. PPI figures, don't worry about it. That came a little bit high. We're going to start to inflect down. Now I'm not so sure. Actually, I'm starting to buy into the narrative that this is longer term. And we can get into that a little bit more, not so much for this video. I want to focus more in the short term, but this was a big, big awakening for a lot of people on the transitory side, which last surveys that I've seen, around 67 to 70% of managers in the marketplace thought that it was going to be transitory after initial spike up in the run in the yield for the 10-year treasury, where people were on the other side believing we're going to have a high inflation, hyperinflation environment. Now people are on this other side again, where it's transitory with the Fed. Well, that kind of just, I think that just ended. But let's get back to COVID, because COVID is explaining a part of this. And here's what we can see. COVID right now is peaking, or at least that's the perspective a lot of people think. I think it will peak on September 4th. I've talked about in a previous video, managers are looking this week to be the peak, the next weekend to definitely be the peak, the latest to be mid-September. If it misses mid-September, oh, the market is going bloody red, with maybe few exceptions. And where that might be is it's not going to be as red in places like Microsoft, like I talked about earlier. Now, what we could have is a UK situation where it peaks and it comes right back at a slower rate. That's also problematic, but it's not going to turn the market that badly down, in my opinion. What it means is that it's probably not going to be as catastrophic in terms of the number of cases every day, although this looks pretty high. If the British don't lock down, we might not lock down. And that's the great fear. And so, how's this involved with the future? Well, if you don't lock down, then it looks like a lot of those reopening stocks, so long as people are willing to go back out and start to actually go to restaurants, take flights, etc., they should rebound somewhat anemically if it rises a little bit slowly like that. But the fall may stop. And we're going to have to see. But the true thing that we're looking for based on the UK figures is that there's this peak here and then we're on the way back down. And you can see the market fluctuate. As this starts going up, there'll be red in the reopening trade, but it at least won't be a catastrophic kind of fall. So it might not be a problem. I can imagine UK going like this and then falling down here. And I can zoom in, it could go down like this and then falling down here and then going back and then falling down here. And you could start to see that gradual, like maybe some red, but the market prices these things in very fast. So maybe as it's peaked and it's going down here, it stops falling permanently and it just doesn't really rise. It might go, down one step, up one step, it goes sideways. And then as it starts falling down here on this curve, on our version of it in the US, you could end up getting some overall movement upward trend that is just grinding itself way up. But big tech probably still going to be ripping as it's been ripping for this entire year. Google up 60% on the year. Go Google. If you haven't had Google, ooh, it's not good for your portfolio because that's really ripped. But in any case, back to the CPI, looks like it's not supply side issues that are being resolved. It looks like Delta, that's a part of it, but also another part. And that's what I wanted to get into that many people didn't even see, that we've got, that we've got the savings rate as well as the personal income that that existed in the second quarter of the 2021, this fiscal year, has actually dropped. Now, the savings rate fell from 20 to 10% because of this. And let's drill down in these numbers. People's income has fallen primarily due to government social benefits falling. What was the big thing we had in the first quarter that we haven't had in the second quarter? That was primarily those stimulus checks, the stimmies. The stimmy checks have fallen off. And if you look at other, it's dropped from 2.5 trillion to just under 1 trillion. I mean, what is that? That's like 150% fall, of course. And then, consumers who are relying on that to spend, that's gone. Are they still strong? Yes, 10% is not a bad savings rate, but they blew away half of the savings they've had, or half of the rate of savings they had. That's going to affect you. Like, oh, I don't have as much money left over in my bank account. And then the other part of it is the fact that, hey, I don't really know what's going to happen with COVID. Are the schools going to be open soon? I need my kids to go back to school, and I'm not able to go to work really if my kids aren't, if the kids are staying home. So that's a big issue. And nobody really knows what's going to happen because of a lot of companies are saying, hey, don't come back to work till October at the very least, and most likely January. And we'll see really if we ever go back to work. I mean, come on, that's just shocking people. Nobody's going to be buying homes. Nobody's going to be like knowing what's going to happen. People are going to be pulling back on savings and pulling back on spending because they need to save. And then let's not even speak about the market retail report that came out. Retailers showed that we had a drop of about 3.9% in spending on motor vehicle and parts, which is not really understandable other than the fact that, hey, we've got enough secondhand vehicles that we're buying. Their prices are too high. And we've got enough uncertainty that I don't want to spend any more money, especially on stuff I already have. And that explains the other parts to this, that we've had, building materials and garden equipment falling, clothing and accessories falling, sporting goods and hobby and musical instruments falling. Really, so much is falling. The only thing people want to spend on is obviously the reopening, which is like food services and drinking places. So that explains why the CPI came down. You know, that 10% on prices for secondhand cars is obviously partly driven by this motor vehicle and parts dealership number that's gone down 3.9%. So it's a demand side destruction that is probably somewhat temporary, as those prices are too high at this stage and until like secondhand cars come in the market. But beyond secondhand cars, overall, the CPI is being hit because of demand due to Delta and probably due to high prices. And we've seen some corporate earnings reports with companies like Caterpillar saying, you know, inflation, it's going to eat up into our margins. What does that mean? Costs are going up and we can't pass it on to our clients or our customers of one form or the other. We're starting to see softening in the housing market. We're obviously seeing softening in the retail clothing stores, foods and beverages. I mean, even all sorts of things. So that can't be just purely Delta, in my opinion. I think that's partly inflation, which gets us to the other part of all of this. What's driving inflation? We've got now global supply chains that are being battered by Delta, the fresh COVID surges. That we've seen that China is basically closing down ports because of one person getting infected with Delta and quarantining the entire working people there due to the strong policy of Chinese lockdown. And so like 400 people can't go to work because, or they're getting shut in their factories without being able to actually go and do anything, getting the supply chain moving forward to the United States, Europe, other places that are maybe more closer to reopening because of better vaccination rates with higher quality vaccines. That's not able to happen. Well, that's going to hit us down the line. But we won't talk too much about down the line. Right now, what we're going to talk about, what we're going to conclude on is that COVID, watch out this weekend, Saturday, those numbers, if they don't come in better than last Saturday, we're going to have a bloody Monday. And that might continue if the numbers keep going up, and we don't want that. And the second part is that it looks like inflation's not going away. Transitory inflation is not a thing. I'm going to make another video talking about reshoring and how that might help partially offset this. We've seen some manufacturing capacity utilization in this month's data come up. That's good. That means the United States is making more rather than using more of that supply side from China. But China is a big part of our economy. Honestly, it's part of the global economy. 40% of all manufactured good that is being supplied to the global economy is coming out of China. Why did we let ourselves get into this position? Well, icing on the cake, the Fed. I did tell you this was going to be a long video, but I hope it's helpful. I'm drilling into this because really, guys, please like and subscribe if you like this stuff. But the Fed is really just got under everybody's skin on the other day. They released their minutes, and a lot of people interpret this like, oh, the Fed is going to move quicker on tapering. And honestly, the market overreacts on that. Do not react to the tapering. When you look at it, the numbers mean that they're going to keep pumping money into the economy up until probably mid-2022, next year, but at a lesser rate. That's not a problem. We've got plenty of money sloshing around. The punch bowl is out there. We need an easing, a slight easing. It does not mean that interest rates will go up. And that's what it really is. It's all about the interest rates. So long as they're not going up at the same time, which they reiterated they will not in the Fed meeting, I think that's a positive thing. I don't see interest rates going up until sometime late 2022 at the earliest, more likely 2023 because of the federal deficit, because the federal debt is so high. We're effectively monetizing that, and there's no way the Fed's going to want to be responsible for a crash in the United States federal dollar, in the United States dollar, and the Federal Reserve and the United States government ability to pay interest. And we see high taxes and a lot of political pressure on politicians to, why we're getting into that kind of a mess. That entire scenario, I don't want to even go down that line. I don't even want to go down that line. So I think for right now, we have some major storms brewing in terms of stagflation because of a drop in demand due to Delta and because of certain parts of the economy they've sold as much as they can sell for the medium term. And we've got high inflation at the same time due to supply chain issues. And that is something that we're going to have to work through. So be careful in your trades. What I'm going to do is I'm looking at the big tech firms that can pass on prices and that can actually do well in both a low inflation environment and a high inflation environment, because they've got a large amount of cash flows today and the ability to raise more cash in the future through greater sales and higher prices that the customers are willing to pay, since they haven't had price increases for like a decade, or at least relatively speaking to the quality of the product that these big tech companies are putting out. On another note, SPACs and all of those are probably going to get wrecked even harder than ever before. I think that's stupid because a lot of those are way, I mean, the ones that you have high conviction in, that you believe in a great value in the future, they're underpriced. I mean, those ones, and there's a big argument between, the backers of the ARK innovation funds and like the Michael Burry short sellers battle the bulls and the bears and the highly, overvalued in the short term companies, but amazing long-term growth perspectives. That's going to be coming in like by the end of this year. That those are going to be amazingly valued. I think we might have a bounce and the bottom there. We'll see. I'm watching it. I've been buying into those, nibbling in, and I want to buy more. So that's where I'm going. Big tech and emerging tech, ones our valuations are increasing while the other ones are decreasing, because this is shorter term. I think they're going to top out at some point. That's for another video. These are longer term, that it's just going to be balancing out. And depending on your portfolio dynamics, you might also want to have also reopening later on, depending on how these trends with Delta is, that's going to be playing out as well. But a lot of the cyclicals with inflation concerns, where their margins are getting compressed, they're in trouble all the way till 2023, maybe. Depends also on the physical infrastructure bill and the social welfare bill, and that all depends on how much people want to take it in the midterms, because honestly, Afghanistan and the extra spending, that plays in the hands of Republicans, not in the hands of Democrats. We're not really sure that's going to be, there's a lot of politicians that like to look out first for their reelection capabilities in the midterm. So we'll see if they'll break with Biden or if they're going to go with him. I think they've passed it in the Senate. Now we're going to see if they pass it in the House. But without those bills, we definitely hit peak GDP, and cyclicals are going to get trashed with few exceptions. All right. I wish you the best. Have a great day and have a great weekend. Like and subscribe.